And now, with sound investing, here's Paul Merriman.
Well, it's great to be back again with just Chris today. Daryl's out on the road somewhere, and he'll be back with us next month when we do our monthly Q&A. But today's special for a couple of reasons. First of all, before we get into the information that Chris Pedersen, our Director of Research, is going to bring us all about the best-in-class ETFs. This is exciting for me. I hope it is for many of you. But before we go there, I have to give a note of gratitude to Chris, because he has very kindly allowed us to offer his book, Two Funds for Life, free as a PDF. And Chris, good to see you, and certainly happy to tell folks that your book is now available at no cost in a PDF format. So just take a few minutes and tell our folks about the book.
Well, it's great to be here as always with you, Paul. And it's also really nice to think that people who may have hesitated to get exposure to the book because of the cost will have a chance to at least crack the cover and take a look at it. It really is it's a deep dive into the Two Fund for Life strategy. I'd like to think it's accessible, but for people who like all the numbers and the charts and the graphs, they're in there. I tried to answer all the questions I needed to answer for myself to make sure it was a prudent strategy. And so that means it's pretty thorough. And a lot of the questions people come to me and ask are answered either in the text or in the appendix. And so in many respects, it's kind of like an owner's manual for the Two Fund for Life strategy. If you like it and you're going to pursue it and you want to stick with it, it aims to answer all the questions you'd stumble on along the way, and hopefully keeps you committed to it and keeps you on the path.
Well, I know there are a lot of people using the Two Funds for Life strategy, because I get emails thanking us for the work that you've done. And I think somewhere on the website, you have a page where there's a collection of questions and answers that you've addressed. Do you know where that is specifically?
Under portfolios, the pull down tab on the website, there is a Two Funds for Life section. And so a lot of that content is there. I'll be working with Margie this year to update that and make it a little bit more aligned with the book and more current. But yeah, there's a lot of Two Fund for Life information there, as well as some videos you and I did.
Okay, that's wonderful. Well, as a matter of fact, I think next to the video about the 12 best Vanguard funds for retirees, your Two Funds for Life video has gotten the most open. So thanks for the work, and thanks for allowing us to make this free to everybody.
Well, and by the way, it's been a fun tag team. We did it together.
Well, it's been great fun. And I might suggest the favor for us that you can do once you have gotten that PDF is to pass it on to as many people as you know that might benefit from that. So that's great. Now, on to the topic of today, which is in some ways one of the most powerful kinds of work that we do in terms of helping investors, because this work can be used in so many different ways. We're going to be talking about the best-in-class recommendations that Chris has created. And you've been doing this for how many years now?
It's probably 5 or 6. It's been a while.
and I know there are a lot of people that are using your work, Chris. And the reason that I say it's some of the most meaningful work in terms of helping people is that, in a sense, you could totally ignore all the other good stuff that we're working on here. You could ignore our asset allocations. You could hand select amongst the different major equity asset classes, all the different ways you might want to put them together. As a matter of fact, you could read the article that the White Coat Investor has entitled 150 Portfolios Better Than Yours. And actually, it's over 200 now. That article was written in 2014, I believe. And it has portfolios, suggested asset class combinations from dozens of folks like ourselves. And if you chose some other strategy, some other combination, you could still use the recommendations that Chris has made for the ETFs. And in a sense, it's a lot more work to doing what Chris does for the best in class. In terms of understanding equity asset classes that we try to help you do, that's pretty easy. In terms of building the portfolios, a lot of work went into that, but once you've got it, there's not anything more than theory to do. And then all the work that we do in combining fixed income with equity, there again, Daryl, of course, updates all that information each year, and that takes time. But what you do with the best in class, and maybe a good place to start, Chris, is just to take people through the process in a way that they'll understand that this is a lot of work and why it is a benefit for having you doing that for them. So just take it away any way you want to explore this topic. And I've got some questions I know I'm just going to wait patiently to ask. So give us a little history and take us through the process.
Well, feel free to interrupt me as we go. I don't really have a presentation to make, but it started when I first came to the foundation and started looking at your content. I could see that you had a Vanguard set of recommendations and you had a Fidelity set of recommendations and a Schwab set. And at my brokerage, I could get access to pretty much any of them. And I was thinking to myself, why do I want to stick with one family? Don't I really want to just pick the best of the best? And so I approached you with that idea, and you thought it was a good one, especially with ETFs. ETFs are widely available. And so then we went down the path of trying to figure out, well, how do you characterize them? How do you decide which ones are best? You know, our portfolios are built around the idea that small is going to beat large and that value is going to beat growth. And so typically that means you want the smaller of if you have two funds, you take the one that's a little bit smaller, the one that's a little more value-y, keep the expenses low, look for a lot of holdings. Low cost is also going to kind of drive you towards index funds or things that don't have some wizard behind the curtain trying to do magic and charging you more money for it. And so the first time we did it, I think it was sort of around that kind of a strategy or that sort of thinking. And then as time went on, I applied a more quantitative approach where I was able to figure out ways to look inside a fund's history and say, well, how much of its return came from its tilt towards value? How much of its return came from its tilt towards size? How much of those premiums am I getting? And if that's consistent, so you can actually figure that out. If it's historically been consistent, we would kind of expect the same exposure in the future. Well, what would the expected return be? And that led to this approach where I basically analyzed the factor predicted returns for these candidates in each of the categories. And that's really, I've talked about that on some other podcasts and kind of the nuts and bolts of how that works. So I don't want to get into that here, but why don't I start by sharing, I'm going to share the portfolios that we aim to populate. That's really where this all starts. Mm-hmm. So when Daryl runs his back tests and you talk about strategies, what we're talking about are these portfolios, and these are available on the website under the portfolio pull down tab. The very first thing is what are our recommended portfolios. And you've heard about all of these. There's the Ultimate Buy and Hold, the Worldwide 4 Fund, the US 4 Fund, the Worldwide All Value, US All Value, Worldwide All Small Value, US All Small Value, the S&P and Small Value, and then some 2 Fund for Life strategies. And for each of these, they draw on this set of asset classes over on the left-hand side, or some people would call them styles of equity funds. But so I'm not looking for the world's best dividend ETF because we don't have a dividend ETF. I'm not looking for the world's best commodities ETF because we don't have a commodities ETF. But I am looking for the best ETF for US large cap blend, large cap value, small cap blend, small cap value on through our assets. And so that kind of sets up the framework. And this is important. These allocations you see in the chart are the allocations that Daryl uses when he backtests the strategies. And these are the allocations we would expect somebody who wants to use that strategy to use when they implement with a set of funds. And you can actually see, I've kind of tipped my hand, you can see the updated list of best-in-class funds here. But before we go to that, let me just talk about, again, what is it we're looking for in these best-in-class funds. So by the time this podcast goes out, this is the content that will be up on our best-in-class recommendations page. And it's going to mention that we have updated the pies and we've updated the portfolio configurator. And there's really one major change, and that's that we removed the what was the recommendations for the international large cap value. We changed it from the iShares MSCI EAFE EFA Value Fund, EFV, to the DFA International Value Fund. It's got a lower expense ratio, it's got more holdings, it's got better value, it's got a better factor predicted return, it's got better historical performance. It's just better all the way around. And we sort of projected that recommendation was coming a year ago, so people could have been adopting it already. But we waited to get a little bit more history, and we also try not to whipsaw people. We only update these once every 2 years. So that change is now in the set. And then the other change is that we've got now emerging large cap value and emerging small cap blend, both listed as best in class recommendations. Now, we don't actually have a portfolio that uses emerging small cap blend. So why have a best in class recommendation for it? Well, the reason is that I wanted to kind of do a tie break between the candidate funds we had there. That was part of it. And then there may be people who want to use a combination of 5% emerging large cap value and 5% emerging small cap blend to approximate an emerging markets part of an all small cap value portfolio. So those are the changes. Those are the top ones.
Can I just bust in here with one?
Yeah, please do.
Because somebody who's new to our work may look at this list and say, now, wait a minute, where's the growth? I mean, where's the beef here that we all know about how great growth is? Why don't I see anything that says large cap growth? Well,
there's fundamentally, you have to kind of pick a strategy. And if you build a portfolio that has growth in it, it's going to offset the value that you have. And over time, you're going to look more and more just like the market at large. You really haven't made a choice. And so if we go back to the portfolios and we look at how they're constructed, they have large cap blend that includes some growth and some value, but we don't have large cap growth, which would exclude most of the blend and all the value. And the reason is that the value has a higher expected long-term return. So growth isn't in there for a reason. It's just not aligned with the strategy, and it's not aligned with the strategy because we don't expect it's going to perform as well over the very long term. Now, we know recently it did great. So there will be periods of time when the choice you have made, whatever that is. You may be a growth investor, right? There will be periods of time when you wish you were a value investor or vice versa. But over the very long term, it seems like you're more likely to be happy tilting to value than growth.
And as you say, there's growth in the blend, whether it's large cap or small cap. And the S&P 500 is part of that large cap blend.
Yep.
That is the fund. And that largely is driven by huge growth companies historically. So you do get some growth.
Yep.
I'm curious again, just for these people who are new to our work, if you had a portfolio that is large cap blend, about how much of that large cap blend would you say is represented by those huge growth companies that we're familiar with?
Well, growth and size are different things. So everything in a large cap blend category is going to be a very large company. I don't know what percentage of a large cap blend fund is growth. I know that the fund that we choose, the Avantis fund, probably has a lower percentage in growth because it leans in the direction of smaller and value just a little bit, but enough to, we think, give you an edge over the long term. And so far, in recent years, at least, that seems to have been borne out.
And we will see that in a few minutes, I think, because I saw some of the style boxes.
Yeah.
Will give us an idea of how much growth is in the portfolio.
Yeah, in fact, that's probably the next place to go.
Before we do, I
Okay.
just go back up there for 1 sec, because you've got these alternative recommendations.
Oh, that's right. Yeah. So the alternative recommendations, these include a lot of funds that are part of other families. So, for example, we have an all Vanguard ETF portfolio recommendation. So all of the Vanguard funds that make that up are in this list. And we have other funds that we have recommended as part of family portfolios that are also part of this list. I wouldn't say that they are equal in quality. I would say that they're in there as the alternatives because sometimes people don't have access to the best in class. And so we've tried to anticipate some of those situations and think about what would be available in some of these areas where we think the selection will be more limited, and found the best option there. Yeah.
Well, and I'm not going to bury people with numbers, but when I think back to what you said early on in this conversation about not wanting to be limited to only Vanguard or only Fidelity, because it appears there are some ETFs that are configured in a way to be more likely to be more profitable over the long run. But just for fun, Chris, I took a look at the U.S. large cap blend group here, and that Avantis fund. Now, 1 year does not a lifetime make, but the Avantis fund last year was down 13.8. On the other hand, the S&P 500 was down about 18.2. Now that is a huge difference, and that difference, from everything you've taught me, has come because of that loading, if you call it that, of some mid-cap companies and more value. And if I looked at another asset class, that's small cap.
If I can just interrupt briefly there, Avantis also values profitability, or the quality of the financial quality of the companies, and that could also be something that played into the difference in performance. But like you said, it's only a year. There'll be years when it goes the other way. So I'm not gonna crow too loudly about that. Yeah.
Well, let me just say that's a topic we ought to address a little later if we can get back to that, because I think it's really important. I also noted, because we have a lot of people who have heard us say small cap value about 1 million times, that the Avantis small cap value fund last year was down 4.9. And the people at Vanguard have 2 to choose from, I think, maybe even more, but they were down about 11. And so the differences sometimes can be pretty doggone meaningful. And I got to remind people that we don't cheer very much when we've lost money. But I feel like cheering if I think that the money you lost was 5% instead of 10%, because in the long run, you win more if you don't lose as much as somebody else. So that I think is very, I think it's interesting. So let's go on and move forward like you suggested.
Yeah. So we've talked about the changes. I also like to analyze the impact on the portfolios and look at how they add up when you sum it all together. And I use Morningstar for that. So I go there and I enter these new portfolio allocations and I do an X-ray on them. And it produces these style boxes, which are kind of interesting. It's a 3x3 grid with value, core, or you can think of it as blend, and growth going horizontally, and vertically it's going from large at the top to medium to small. And I do this for the Vanguard, the DFA portfolio, which we've used as a reference historically. And then I compare the 2021, the last set of recommendations, to the 2023 recommendations for the ultimate buy and hold. And then I show the 4-fund combo US and worldwide, and the all value worldwide and all small value worldwide. And so, what you see here is that Vanguard in an ultimate buy and hold portfolio ends up looking, it's tilted towards value, but it actually has its core, its center is actually up in kind of large blend. The DFA reference shifts more towards value. It's shifted to the left. And both the 2021 and 2023 best-in-class ETFs are still shifted to the left and maybe a little bit down, so you get a little bit more of a value and size tilt in those. And then I guess the other piece is to look at in terms of the changes let's focus in on the changes from 2021 to 2023 best-in-class ETFs. The price to book ratio went down slightly from 1.15 to 1.13. The average company size went down slightly from 8.6 to 8.36 billion. The expense ratio went down slightly from 0.26% to 0.25%, and the yield went down slightly, which from 2.58 to 2.55. So tiny differences, and this may come into play as we talk about the next thing, which is should you switch? Because that always comes up.
Yeah, let's just spend a couple more minutes on these style boxes, because in the process of trying to teach people about how investing works, these style boxes are one of the best teaching tools that I know in terms of understanding how the academics break down their view of the differences between these particular asset classes. And by the way, the other thing that happened between 21 and 23 is you do get changes in the market itself. In terms, as the market goes up, you can have the price to book ratio changing over time. And of course, then what's important then.
Well, that's just to be clear, though, although that's true, I rerun this analysis with all of these portfolios with the data from January 31st, 2023. So that change in the market attributes over time gets wiped out. I try to get rid of that, because you're right, that would make the comparison suspect.
Yeah. Now, how difficult for people who, and I know some of our people who follow our work know how to do this. How difficult is it for the beginner to learn how to take the funds they're in or the ETFs they're in and build their style box so they can see how their portfolio compares to the portfolios that we're recommending?
You mean, how difficult is it to create a Morningstar X-ray?
Exactly.
I think it's pretty easy. I mean, the first time I did it, I don't think it took me half an hour, maybe 20, 30 minutes.
Mm-hmm. And it's free. By the way, for those of you who are not taking the free subscription from Morningstar, you are missing one of the richest sources of data. And as you know, we have our truth tellers, the people that we think are really special in terms of the information they're bringing. And two of those truth tellers, John Reckenthaler and Christine Benz, are with the Morningstar organization. So I hope it is a site that you'll get to know.
Did you have any other questions about the style boxes while we're here?
Just again, to help people as they look at this, when I talked a few minutes ago about those difference in returns, last year, those companies with lower price to book ratios did better in the market. And so when I look at the Vanguard price to book at 1.41 versus the BestinClass, let's say at 1.13, that's close to a 30%, or let's call it 25% difference. That's a meaningful amount from your research, Chris, I assume. And would it be fair to say that that's 0.25%, maybe even 0.5% a difference over time?
I think that would be a reasonable kind of expectation for having a portfolio that's better constructed, tilted more towards small, more towards value. For people who want to dive a little bit deeper into this cross-section of returns topic, I'd point them to chapter 5 of my book, where I have a table that lays out what the historical returns have been for each of these 9 boxes.
Oh, great.
Which I think is really interesting. And it also has the drawdowns that were experienced from 1972 to 2021. And one of the things that you take away is that the smallest return is this bottom right-hand box, the small cap growth. And it was at 10.53%. That was the nominal return. Still a good return, but it was small. But the real gotcha is that return came with the highest drawdowns by far at 64% worst case drawdown. So that bottom right-hand corner is a danger zone. And later on, when we look at the configurator, the updated configurator, you'll see how all of these portfolios they create an arc, like trying to avoid that danger zone. It's really interesting. Yeah.
And I think people, if they don't know why that tends to happen, it's pretty easy to see that growth companies, people get really excited about. And
it's the promise, the dream. And they're willing to pay
outrageous prices. Then when they find out the difference between the courtship, the honeymoon, and reality, then those things can, as we've seen, many of those companies in the last years fell 80-90%. Yep. And so, and those were big growth companies, by the way, that happened too. So, and just there's one more thing on this page that I get a lot. I'm sure you do too. And that is, why should I pay 25 basis points, 0.25%, when I can invest and only pay 0.1%, or even less if you wanted to, And I just want to make sure people understand those return differences that you've tracked. That is after the expenses, correct?
It is the projected returns and the historical returns they're based on include expenses. So the reason you would spend an extra 0.15% is because you expect to get another 1% or 2% returns. And that is my genuine belief that the best-in-class ETFs should outperform if the future looks like the past, well more than enough to cover the 0.15%. It may come with a little bit more bumpy ride. That's something to consider. But the flip side of that coin is I guarantee you, and I can't guarantee you many things, but I guarantee you that if you use the Vanguard portfolio instead of the best-in-class ultimate buy and hold portfolio, you will have lower expenses. I guarantee you that.
That's good. I like that guarantee.
And that's why some people may prefer that. I have friends who are very knowledgeable. They know all of this information, and they're still invested 100% in Vanguard funds for two reasons. Number one, they know that the expenses matter and they want to keep them low. And number two, they trust Vanguard. Vanguard is mutualized. They're owned by their investors. They only behave in a way that is in the investor's best interest, and more power to them. I wish them the very best of luck.
Well, but the other side of that coin is all of these ETFs in the best-in-class list are available through Vanguard with no commission. So you can still get them at Vanguard. And as we talked a little bit recently, over at Fidelity, you can get all of these best-in-class ETFs and buy and sell with partial shares, which means you don't have to figure out how many shares you can afford with the money you got. You can just say, give me $1,000 worth, and you'll get 19.256 shares. That's really a big deal. But even if you're at Vanguard, you can take advantage of these recommendations if you wish.
Well, we should probably move on because I think we already have a three-sided coin here because we used that analogy 3 times. So, all right. So one of the very first questions people are going to ask is, should I switch? I mean, there's not that much to switch this year, right? There's really just one fund. And I will say that DFIV is among the changes we've made, one of the more worthwhile. I think DFIV versus EFV is a substantial upgrade, but there's costs involved with changing. If it's in a tax deferred account, it's probably less of a concern. But if it's in a taxable account, I would, slow down, think carefully. How much